Welcome to Inside Corporate Finance, where we bring clarity to complex market dynamics. Today's episode is all about market anxiety. Stocks are dropping, Treasury yields are falling, and the word recession is echoing louder across trading floors and boardrooms alike. We're going to unpack what's really driving this market pullback, from tariff tensions and Trump's trade policy to the rising cost of credit and pessimism in investor sentiment. We'll also look at the broader picture, how major indexes are reacting, why investors are shifting into safer assets, and what this all means for companies like Apple, Tesla, and DoorDash, which are already seeing pressure in pre-market activity. Make sure to subscribe to the channel and share this episode with your team or LinkedIn network. This is the kind of market insight that should be on every CFO's radar. Let's get into it.
Welcome back, everybody, for another deep dive. This time, we're going to unpack all this, this financial fallout, right? Like from all the recent economic, all the stuff that's been happening.
Right.
We're going to look specifically at how the markets are sort of reacting to all these potential shifts in trade policy.
Yeah.
And, everybody's been kind of whispering about a recession.
Yeah.
So today we've got like a whole stack of breaking news, hot off the presses, and a ton of expert opinions, and it's all from today, March 10th. 2025.
Fresh.
Super fresh.
Ooh.
I've been looking at sources like Bloomberg, investing.com, Yahoo Finance, all the big ones. So the big question is, how much do all these, presidential pronouncements actually affect your investments?
Your portfolio.
Right.
Right.
Let's find out.
Yeah, I think, the interesting thing that we're seeing here is like a convergence of a few different factors, right? You've got like the potential for trade policy changes. You've got, anxieties about a recession are definitely growing, and just like a general sense of uncertainty about the future. And that's why I think, we're seeing all this volatility in the markets this week.
It's, it's been like a roller coaster.
Yeah.
Not the fun kind either. The S&P 500, that dropped 1.7%.
Mm-hmm.
The Nasdaq, all the tech stocks there, that took like a 2.4% hit.
Wow.
And even like the Dow Jones Industrial Average, Old Faithful, that slid down 0.8%.
Yeah. And I think what's important to note is it's not just a U.S. phenomenon, right? I mean, we're seeing this globally. So like in Europe, the Stoxx 600, that dipped 0.9%. And then the MSCI World Index, that's down 1.5%.
Wow.
So it's, we're really seeing this kind of widespread impact. And then you couple that with, this classic flight to safety we're seeing, where investors are basically moving all their money into bonds. And that's actually what's driving the yield on the 10-year treasuries down to 4.23%.
Oh, interesting. Okay, so it's not just the drops, right? It's like how people are like reacting to all of this.
Right.
Is that kind of, it seems like a lot of this anxiety is stemming from Trump, from former President Trump, and his like recent comments about the economy just being in a period of transition. He's avoiding saying recession.
Right.
But, people are reading between the lines.
Absolutely. And I think that really raises the question of like, how much weight should we really be giving to presidential pronouncements?
Right.
Especially when we're thinking about our own investments. We know that Trump's like whole pro-growth agenda, that was a huge market driver during his presidency. But now you've got those tariffs, you've got government firings, and, people are definitely starting to raise eyebrows. Like JP Morgan Chase and Co., they've kind of, they've tempered their like super bullish outlooks for 2025. Yep. And even like RBC Capital Markets, they're a little bit more, they're expressing some serious concerns about like this prolonged economic uncertainty. And then you've got people like Michael Wilson over at Morgan Stanley, and he's like straight up worried about increased volatility and, potential threats to growth stemming from all those tariffs.
It's like the market just like took a pause and was like, wait a second, what's actually going on here? Yeah. It's not just like the big players. For the first time since 2022, like most individual investors, they're saying that stock prices are going to drop over the next 6 months. Like that's a huge shift in like how people are feeling about the market.
Right. And speaking of how people are feeling, let's talk about those recession fears. Okay. Because, U.S. credit risk, it's definitely going up, up, up. Yeah. And a lot of that has to do with those tariffs and all those job cuts. It's really fueling anxiety,
We're seeing it in a very specific way. The AII, the U.S. Investor Sentiment Bearish readings, which is basically like, the percentage of investors here like, oh, this is not looking good.
Right.
Those are like almost at the highest point they've been since 2022.
Yeah. That's not exactly inspiring confidence.
No.
And all this negativity is starting to show up in like actual market behavior. We're seeing all these like high-grade companies, they're delaying their corporate bond sales.
Oh.
It's a total classic sign of like, oh, I'm a little risk averse right now. So, we've got market volatility, presidential influence, recession fears, all this stuff is swirling around. But there's this other term, and it's enough to make any economist sweat.
Oh, no. What is it?
Stagflation.
Oh, stagflation, right?
Yeah. That like toxic combination of, slow economic growth with high inflation.
Oh, that's the nightmare scenario, right? For businesses and for just normal people.
Oh, absolutely. And Evercore, they're, an investment banking firm, and they've been crunching the numbers. And honestly, it's a pretty grim picture they're painting. They're saying, if all these stagflation fears, if they actually happen, we could see the S&P 500 plummet to 5,200.
Oh, wow.
Which is a significant drop, from where we are right now.
Yeah.
And their analysis of, like the long-term impact of all these tariffs, that's particularly troubling. They're predicting that the tariffs could push, core PCE, which is like, a measure of inflation, but it doesn't include like the food and energy prices, which are always volatile.
Right.
They're saying it could push that up by 0.5 percentage point, like year over year.
Oh, wow.
And then to make matters worse, they're also saying that those same tariffs, they could cut monthly job creation, like anywhere from 30,000 to 70,000 jobs.
So we're potentially looking at slower growth, higher prices, fewer jobs. Like how should someone, like an average person, like think about like what stagflation would mean for their own money?
Yeah.
Like what kind of questions should they be asking themselves?
Right. It really comes down to like, are your investments ready to weather a storm like that? Would your current job, your income sources, would they hold up in a stagflationary environment? It's not fun to think about, but I mean, those are kind of the questions you've got to be asking yourself in this climate.
Right. Okay, so we've talked stocks, we talked bonds, and like the general like economic outlook. But what about crypto?
Oh, yeah.
What's happening in the crypto world with all this?
Well, the crypto market hasn't exactly been super enthusiastic about all this. Like Trump's recent crypto summit, his announcement about, a national Bitcoin reserve.
Right.
It kind of got a lukewarm reception.
Yeah, it seems like the market was like, yeah, we see what you're doing there. Like it didn't really land, did it? Not
really. I mean, a lot of that reserve is basically made up of seized crypto, so it doesn't really look like the government's, going to be doing a whole lot of buying. Yeah. It feels more like a PR move than like a real change in policy.
Okay, so and the price action kind of reflects that.
Yeah, definitely. I mean, Bitcoin's down 2.48% today. It's trading at 82,968. Ethereum's also feeling it, down 1.5% to 2,102.64. And, those altcoins, they're not doing so hot either. XRP, Solana, Cardano, they're all down, like significantly.
Even like MicroStrategy, the company that, like famously went all in on Bitcoin.
Right.
They're feeling it too.
Yeah, they're still like the biggest corporate holder of Bitcoin.
Right.
But their stock has dropped more than 40% since Bitcoin hit that, all-time high back in November.
It's a reminder that like even the people who are like the most, bullish on Bitcoin, even they're not immune to like the market taking a downturn.
Right.
But I mean, MicroStrategy, they're not backing down. They just announced this, like $21 billion ATM offering to buy even more Bitcoin.
Yeah, they're doubling down.
So is this like a buying opportunity then for crypto? Or is this like, things are going to get worse?
It's tough to say, the crypto market, it's like notoriously unpredictable. Yeah, it really does. It just adds like another layer of complexity to what's already like a pretty volatile situation. And I think while we're talking about, like specific moves in the market, it's important to remember that even with all this like broader turmoil happening, individual companies are having their own ups and downs.
Yeah, that's true. It's easy to get caught up in like the big picture stuff.
Right.
But those like micro stories, they can be super insightful. Like, you can see those sector specific trends. For example, Tesla, they're feeling the heat today. Their stock's down 3.6% in pre-market trading.
Yeah, and it's not just because of the overall market, like they're having some protests erupting at their gigafactory down in Austin.
Oh, really?
Yeah, over allegations of like unsafe working conditions and stuff.
Oh, wow.
And, this really highlights how important those environmental, social, and governance factors are, the ESG,
right,
when people are making investment decisions. Because, like, negative news on that front, it can really, like, tank a company's stock price.
Like investors are looking beyond just the financial performance now.
Right.
They want to see like ethical and sustainable practices.
Absolutely.
It's like Apple, they're down 1.3% in pre-market trading, and it's because of these delays with their iPhone sales.
Yeah, and delays like that, they can be super costly for like these big tech companies, especially when it comes to these products that everybody's like really hyped up about,
Right.
because it throws off all their revenue projections. And
Yeah.
then people start to get, concerned about whether they can actually pull off their strategic plans.
Okay, but on a more positive note, DoorDash, they're actually seeing a surge in pre-market trading. They're up 3.8%.
Yeah, isn't that interesting? They actually like lowered their estimates for the year.
Yeah.
But investors seem to be responding well to their focus on those key growth areas.
It's like the classic exceeding low expectations thing.
All right. Sometimes, if you set the bar low and then you like jump over it, it kind of signals to investors that, you're being realistic. You've got a good handle on your business.
Right.
You're managing expectations.
And speaking of exceeding expectations, Redfin, the real estate brokerage, their stock, it just like soared 70% after they agreed to buy Rocket Homes for like $1.75 billion.
Whoa, that's a bold move.
Yeah.
Especially in like this crazy real estate market we've got going on.
Right.
It really seems like Redfin, they see this as a chance to like really expand their market share and capitalize on, Rocket Homes' technology and their customer base.
And it seems like, Wall Street's on board with it.
Oh, yeah.
Because a bunch of analysts, they've upgraded their ratings on Redfin.
Oh, interesting.
And that's, pushed the stock price up even more.
And, those analyst upgrades, they can really act as like a catalyst for short-term price movements. Because when you've got like these really respected analysts and they change their outlook on a company, it can really sway how investors are feeling and like trigger a ton of buying or selling.
It just shows how interconnected everything is.
No, absolutely.
From like what a president says to like how a company's earnings reports look to like, analyst ratings, it all feeds into like this big, complicated market tapestry.
Exactly. And, it's our job as informed investors to try and figure out the patterns and find the opportunities in all the noise. Speaking of expert opinions, let's dig into some of the latest market analysis and see what we can learn.
Okay, I like it. Let's start with Citi. They're predicting that the S&P 500 could hit 6,500.
Wow.
Which would be like a huge rebound from where it is now.
Yeah, that's a pretty optimistic outlook considering all the jitters we've been talking about.
Right.
It kind of suggests that Citi, they think this whole downturn is just like a temporary thing and that the fundamentals of the U.S. economy, they're still solid.
Okay. But they are like acknowledging the whole tariff thing.
Right. They're not ignoring it. They're basically saying that if they can work out the whole tariff situation, it could be a good risk-reward scenario for investors.
Right.
Which makes sense because, all this uncertainty around trade policy, it's like a huge weight on the market.
Yeah.
So if they can make some progress there, it would definitely make investors feel a lot better.
Okay. So Morgan Stanley, what are they saying?
They're being a little more cautious. They're saying the S&P 500 will probably trade between 500 and 6,500 for the rest of the year.
Okay.
So they're basically acknowledging that there's potential for it to go up or down.
Right.
Volatility is the name of the game.
Yeah. They're not like making any big bets.
Right, exactly. Their analysis really underscores like just how uncertain things are right now.
All right.
There are good arguments to be made for like a bull market and a bear market.
Yeah.
So investors really need to be prepared for anything. Okay, now BCA Research. They're an independent investment research firm, and they're suggesting that investors diversify their portfolios by allocating to European sectors or stocks.
Oh, interesting. So they're saying like don't put all your eggs in the U.S. basket.
Right, exactly. Look beyond the U.S. for opportunities.
Okay.
And they're especially bullish on European equities that aren't like super tied to the U.S. market.
Okay.
They think those are going to keep doing well, especially as like those magnificent 7 stocks, the 7 biggest tech companies that have been driving all the games lately.
Right.
They think those are going to start to lose some steam.
Interesting. So they're betting on like a shift in market leadership.
Exactly. Now, RBC Capital Markets, they're still cautiously optimistic about the U.S. market. They know there are risks, but they think the S&P 500 could still go up.
So, I mean, we've got a real mix of opinions here.
Right.
Some are bullish, some are bearish, some are like somewhere in between.
Yeah.
So, like, how do you how do you deal with all this conflicting information? If you're an investor, what are you supposed to do?
Right. Well, the key is to not freak out and overreact to any single prediction or opinion. Don't panic and sell everything just because one analyst is saying the sky is falling.
Right.
But also don't go all in on some risky bet just because someone else is feeling super bullish.
Okay.
It's all about finding that balance, and keeping things in perspective. Do your own research, figure out how much risk you're comfortable with, and come up with an investment strategy that actually aligns with your goals.
It's like you always say, informed investors are empowered investors.
Yeah. Exactly. And speaking of being informed, let's shift gears a little bit and talk about some of the political and economic forces that are shaping the market landscape. We can't talk about the current climate without addressing, the elephant in the room, the trade tensions between the U.S. and China.
Right. Yeah. That whole thing.
I mean, they've been a source of uncertainty and volatility for years now.
Yeah.
And they're still weighing heavily on market sentiment. Those tariffs that both countries have imposed, they've messed up global supply chains, increased costs for businesses, and just created this overall feeling of unease among investors.
And it's not even just about the direct economic impact of the tariffs, right? It's the bigger geopolitical stuff too.
Oh, absolutely. I mean, these trade tensions, they strained relations between the two biggest economies in the world.
Right.
It's created this environment of distrust.
Yeah.
And this rivalry, it goes way beyond trade. It's about competition and technology, military power, global influence. It's playing out on a global scale, and it's creating this super complex and unpredictable backdrop for investors.
And then, on top of that, you've got the domestic political landscape in the U.S.
Oh, right.
I mean, we have a presidential election coming up next year.
Yeah.
Which always adds another layer of uncertainty.
Absolutely. Election cycles, they can be super volatile.
Yeah.
Because investors, they're trying to figure out what policy changes might happen with a new administration.
Right.
And with how divided things are politically in the U.S. right now, is anyone's guess how the election's going to go and what impact it will have on the economy, and on the markets.
So, trade wars,
yeah,
geopolitical rivalries, a crazy election coming up.
Yeah.
It's enough to make anyone nervous, even if you've been doing this for years.
Right. I mean, it's totally understandable to feel that way. These are complicated times. There are no easy answers, no guarantees.
Right.
But it's important to remember that uncertainty, it's always there in the market. It's a constant. And it's how we react to that uncertainty that really matters.
Right. And I mean, one way to react is to, stay informed and engaged.
Exactly.
Which is why we're doing this whole deep dive thing. We want to give you the knowledge and insights you need to make good decisions about your investments.
Absolutely. Knowledge is power, The more we understand about how economics, politics, and market psychology all work together, the better we'll be able to navigate all this craziness.
Well said. Okay, so let's shift gears again and talk about something that's been getting a lot of attention lately. Artificial intelligence.
Ah, AI.
Yeah, AI. I mean, it's changing everything so fast.
It really is. It's transforming industries, sparking all these debates.
Right.
And really capturing people's imaginations, Investors, entrepreneurs, everyone's talking about it. It's everywhere you look. Self-driving cars, personalized medicine, algorithms that can write poetry. It's mind-blowing.
Yeah, it really feels like the potential is limitless. And investors are pouring billions of dollars into companies that are developing and using this technology.
It's true.
We're seeing AI in finance, healthcare, retail, manufacturing, you name it. It's a total game changer.
Yeah.
And we're just getting started.
Exactly. We're just scratching the surface. And the market is definitely paying attention. AI-related stocks, they've been going through the roof in recent years.
Right.
And a lot of analysts think that's just going to keep going.
Yeah, it makes sense. But, I mean, with any new technology, there are always risks.
Oh, absolutely.
Some experts are worried about, job displacement, ethical problems, even the possibility that AI could become, too powerful.
Right. Those are all valid concerns.
Right.
We need to be thinking about those things carefully. Any powerful tool, AI can be used for good or bad.
Right.
And we need to make sure that it's developed and used in a way that's ethical and benefits society.
Absolutely. We need to have those tough conversations about the implications of AI and work together to make sure it's used responsibly.
Right.
But, we also don't want to lose sight of all the good that AI can do.
Right.
I mean, it has the potential to help us solve some of the world's biggest problems.
Yeah, climate change, disease, poverty, the list goes on.
It's a really exciting time to be following this space.
It really is.
The innovations happening in AI are incredible. It's fascinating to see how it's shaping our world. It's a good reminder that even with all the market turmoil and the geopolitical stuff, there are still reasons to be optimistic. Human ingenuity, technological advancements, they're still driving progress, creating opportunities for investors and for everyone, really.
Well said.
It really is.
Sure.
It's like even in all this uncertainty, there's still so much innovation happening. But, okay, let's talk about something a little closer to home for a lot of people. Interest rates.
Yeah.
The Fed, they've been kind of hinting at maybe cutting rates this year, but now with inflation still being a thing, it's like things are getting complicated.
Oh, the Fed is definitely in a tricky spot. They're trying to walk this like really fine line between controlling inflation and also supporting growth.
Yeah.
And with all these mixed signals we've been talking about, like worries about the job market, fears of a recession, it's a tough balancing act.
It's like they're trying to juggle chainsaws while riding a unicycle or something.
Right, but it really does highlight the challenge they're facing. Like, if they cut rates too soon, they could accidentally make inflation even worse.
Right.
But if they wait too long, they risk, tipping the economy into a recession.
So what's the most likely scenario here?
Well, the bond market is already, kind of pricing in at least one rate cut this year. But ultimately, what the Fed does is really going to depend on how the economic data looks over the next few months.
Okay, so it's something to keep an eye on.
Definitely. Interest rates, they affect everything. Mortgage rates, how much it costs companies to borrow money, consumer spending, it all ties in.
Totally. Whether you own a home, run a business, or just trying to manage your money, it's important to understand what's happening with interest rates.
Yeah, it's one of the most important indicators of how the economy is doing overall. And it can give you some clues about where things might be going.
Okay, so we've talked stocks, bonds, crypto, interest rates, the whole geopolitical landscape. Is there anything else investors should be thinking about right now?
Well, one trend that's really gaining momentum is sustainable investing. Or, ESG investing, as some people call it.
Right. ESG. That's where investors are looking beyond just how much money they can make.
Exactly.
And they're also thinking about the environmental, social, and governance impacts of their investments.
Yeah, they're looking for companies that are not only profitable, but also operating in a way that's sustainable and ethical.
Yeah.
Companies that are being responsible corporate citizens.
And it's not just a feel-good thing, right?
Yeah. No, not at all. There's more and more evidence that companies with strong ESG practices, they actually do better over the long haul.
Really?
Yeah, there have been studies that show companies with higher ESG ratings, they tend to have less risk, more profitability, and they're more resilient when the market gets volatile.
So it's not just about doing good, it's also about making smart investments.
Exactly.
Yeah.
ESG investing is about aligning your values with your investments, creating a portfolio that reflects the kind of future you want to see.
So it's like a win-win. You
Right.
support companies that are making a positive impact, and you could also see better returns.
Exactly. It's a powerful combination. And it's no surprise that ESG investing is becoming more and more popular.
Okay, so let's wrap this up. We've covered so much today, from those market jitters to presidential pronouncements to the rise of sustainable investing.
It's been quite a deep dive. We've looked at economic data, political events, technological advancements, and how investor sentiment plays into all of it.
We've analyzed expert opinions, broken down key market trends, and hopefully given everyone listening the knowledge and context they need to navigate these kind of crazy times.
Absolutely. And, as we always say, knowledge is power.
Right.
So stay informed, think critically, and never stop learning.
Couldn't have said it better myself. And on that note, we'll wrap up our deep dive for today. Thanks for joining us, everyone. Remember, informed investors are empowered investors.